Good evening, everyone, and a very warm welcome to the series of update webinars that Edelweiss Asset Management conducts on an ongoing basis for our clients and partners. My name is Varun Sanan. I head the Mumbai zone for Edelweiss, and I'm your host for the evening today. Today, we will be presenting an update on the Edelweiss US Technology Fund that feeds into the underlying, which is the JPMorgan US Tech Fund. As you'd recall, we launched this strategy in Feb of 2020, right before the pandemic hit. And what happened in the ensuing months was there was a complete global lockdown. As the global lockdown spread, all of us, we turned to what? Technology, right? For our businesses, for our schooling, entertainment, social engagements. And tech hardware and software took over. And tech was basically our life. This was just not standalone in isolation. It had a huge ramification on the stock of technology companies. And FYI, the JPMorgan US Technology Fund in 2020 was up close to 88% in US dollar terms. What happened later was the pandemic got taken out, and we had vaccinations and herd immunity, etc. As the world opened back up in 2022, the opening up of the globe saw supply chain disruptions. There was a huge surge in consumption as there was ample liquidity by a lot of stimulus that was done by the Western world, which led to unprecedented amount of inflation, coupled by the fact that there was a war in Ukraine, which pushed energy prices up, which caused further inflationary pressure. The central banks, led by the US Federal Reserve, had to tighten interest rates, and rates started shooting up. This had a negative impact on US equities, and tech stocks and US equities gave up some of those gains of 2020 and 21. But what we saw was a clear reversal of some of those trends in 2023. And the market started to retrace their path forward, and S&P 500 year to date returned close to 17%, led hugely by, guess what? Tech companies. And to very little surprise, the Edelweiss US Technology Fund year to date stands at close to 50% in Indian rupee terms. Clearly, we move into uncharted waters now. And to make more sense of what lies ahead, I'm joined by Mariani, who is an investment specialist on US equities with JPMorgan Asset Management, which basically manages the parent fund, which is the US Technology Fund, in which the Edelweiss US Tech Fund feeds into. Hey, Christian, welcome to the call.
Hey, Varun. Thanks for having me. Great to be here.
Fantastic. Let's jump right into this one. Now, given the fact that what's happened in the last 3 years, it's been quite a ride. And now I think the burning question is, where does the US economy go from here, and what's in store for US equities?
Yeah, sure. Thanks for the question. Perhaps we can start on slide 6 just to give like a quick overview of what we are thinking. And I think when people think about the US economy for the last year or so, we have been talking about the prospect of a recession. Why? Because the Federal Reserve have been hiking rates at one of the fastest pace ever for decades we have seen. We have seen a slowdown in parts of the market in terms of earnings as well. But I'd say that overall, if you look at how corporate America has been behaving so far, year to date, actually that recession didn't really materialize in the way that most of the people would have thought. And that's why when we think about recession, we think about there is this kind of obsession about a recession and when is it going to happen. But at the same time, one of the things what we do is we speak to companies every single day and trying to understand from management team what they are seeing in terms of the outlook. And one of the things that I will highlight is that while profitability has been coming down in parts of the market, the sectors you see, I think technology is one example of a sector which for a few quarters already went through some negative earnings on a year-over-year basis for large cap companies. At the same time, the earnings are better than what people expect. And that's why I'd say the overall profit dollars in the market are still quite elevated. If you look at the revenues of these companies are still going up margin has been contributing a little bit negatively, but overall, it doesn't feel like a recession, like 2008 or 2020. And I think, there is no need for a recession to necessarily be like 2008 or 2020. So, in terms of like our research analysts, what they expect for 2023, it's minus negative 2% year-over-year growth for the S&P 500. So again, it's more of like, it feels more of a slowdown rather than like a recession. The other things which is important to look at is when we talk to companies, what about CapEx spending intentions? And we have seen companies reducing costs where they can, but they have not been too aggressive in doing so. I think tech has been a little bit the exception, where you've seen rounds of layoffs last year and parts of this year. If you look at Meta, one example which laid off about 30% of their headcounts. But otherwise, outside of tech, we haven't seen that, which again, it means while you see a little bit weaker CapEx intention, it's not as bad overall. And the final piece to it, I think, is the consumer. And again, consumer make up of 70% of the US GDP. And that's critical for, the US consumer to do well in order for the US economy to do well. And what you're seeing is that the job market is still relatively strong in the US. Unemployment rate is still relatively low, one of the lowest we have seen. If you look at job openings, it's a little bit less than we have seen over the last few quarters, but still pretty strong. The numbers of people which feel comfortable in quitting to find a new job as well. So, in a sense, the picture from the consumer side of things is still of a consumer which definitely has been trading down in some areas because of high inflation. And as you mentioned, some of that stimulus has been fading away, but at the same time, it's not doing badly either. If you think about what a recession means, you typically see a large surge in unemployment. We haven't seen that so far. There are two risks which I would say we need to kind of carefully look at. The first one is, what if corporates start to cut CapEx too aggressively? That will be a problem. But so far we haven't seen it. And then the second one is think about like other geopolitics or the Federal Reserve doing a mistake, like hiking too far. And I'd say the expectation, if you talk to our colleagues in Market Insights, is for probably 1 to 2 further hikes, and then that's it. And as you look into 2024, likely to see some rate cuts. And our fixed income team will also tell that next year you're likely to see some rate cuts. So again, it's like we might go through a slowdown. That slowdown might not feel like a large recession like 2008 and 2020. And because of like where we were starting at, like at the beginning of this year, the market sold off like dramatically last year, 20% the S&P, but parts of tech were down 60, 70%. Then the market has been re-rating higher for kind of a less bad scenario going forward.
So what I make sense of what you've said is that there is not really a big recession that's coming our way. It's more like a slowdown, which is probably already baked in most of the stock prices. Now, given the fact that, we're now hearing about the US Federal Reserve changing the course, probably just a couple of more rate hikes on the horizon. And then, like you mentioned, 2024 would see interest rates going back down. How does that really augment for US equities? Do you think the rally that's happened in 2023 is essentially factoring in all of those prices, or there's more legs to go?
Yeah, I think, the market is always forward looking. So, to some extent, some of that is probably, some kind of soft landing. And, some rate cuts are probably something that the market is looking at. But at the same time, I would say that what we see as a positive sign, which could then feed into the market, like in terms of like returns over the next 6 to 12 months, and we show that on slide 9, is that the earnings, and just remember over time, if you look over 5 or 10 years, you will see the market is being driven by earnings. And, first of all, on the right side, you will see how, the S&P 500, that's the dark blue line, goes up over time. And then you will see the next 12-month earnings, the pattern is clear that when earnings goes up over the next 12 months, you see the S&P also going up over time. So what we have seen over the last few months, and that's on the left side, is actually like earnings expectation forward looking for the next 12 months starting to improve. The market, again, part of the market, especially like parts like technology or communication services, which takes a huge chunk of the S&P 500, already went through an earnings slowdown. And as we see, these companies are doing the right things to, first of all, to bring down cost. And let me just give you an example. I was talking about Meta before. Meta is one of those companies which, after a 2-year period during the pandemic, which went on a hiring spree, and they couldn't sustain that pace. Like what they've been doing is they've been reducing headcounts to drive better efficiency, driving costs down. But at the same time, what we are seeing is that the revenue growth over the next 4 quarters is reaccelerating. So that's why on the left side, you see that blue line is trending higher once again since the kind of the beginning of this year, after it has been trending down in terms of the expectation of the next 12 months for more than half a year. So you're starting to see some signs that actually from an earnings perspective, like the worst might be over because some of these big sectors already went through that downturn. Second quarter 2023 is currently expected the worst in terms of an year-over-year earnings growth for the S&P. So as you're looking forward, this improvement in earnings, if it feeds through, then it should be helpful in terms of like the market being sustained. Again, I wouldn't say in the short term, it's not possible to see some volatility and some sell-off. Over the short term, like that can always happen. But if you have that 6 to 12 months kind of time horizon and you start to see this improving earnings trend, that's positive for the market overall.
Interesting. I'd also like you to help us understand how are we looking at the markets in terms of valuations, especially valuations of the tech sector. And you mentioned very interestingly about earnings going back up. What do you think are the real fundamental growth drivers for these earnings to go back up? Is it that demand's coming back? Is it the fact that businesses are realigning themselves to the future prospects of technology, or what exactly is the growth driver right now?
Yeah, let me maybe start first with this question, and then I go back to valuation. So if you just go on slide 7 first, what I want to show is that if you look on every single quarter for the last 1.5 year, what you see here is how the S&P year-over-year earnings look like. And you can see that we came off, end of 2021 from very strong growth, 27% year over year for the S&P. That has been decelerating over the next few quarters. And the S&P already entered negative earnings growth for 2 quarters. But if you dig one layer kind of deeper, you see communication services went through a few quarters of almost 30% year over year growth and negative growth. Similarly, if you look at tech, the last quarter for the S&P 500 tech names, it was down 20% year-over-year earnings. So to some extent, there is a base effect which is coming to play over the next 12 months, where the starting point for a lot of these companies is much easier in terms of to grow earnings looking forward. The other point is down to what I mentioned before. These companies have been reducing costs proactively, and they are taking actions to monetize, on the opportunity. I'll give you another example, which is Netflix. Netflix over the last year went through, a quite big change in terms of the business model, adding an ad-tiered offering, where they have advertisement. So that way they can monetize through, those businesses which want to do advertisement on their platform. And then secondly, also been cracking down on password sharing. These actions, they're not, again, it's not about necessarily reducing costs, but it's about finding new way to grow and to monetize the opportunities. So as you went through this kind of rolling, let's call it earnings recession for parts of the market already, technology is the first one which is starting to get out of it. There are other sectors like energy, which didn't really go through that and will go through, a period of deceleration and negative earnings growth. But the important thing is that energy is a small part of the S&P. So again, when you think about the S&P and you compare to maybe the real economy, there is a difference there because the S&P is, predominantly tech driven. And, energy financial is much smaller component of it. On the next page, on slide 8, you can see some of the improvements you see on some of these large tech companies. So here we're showing Amazon, Google, and Meta together. If you look at the net income growth or earnings growth, you can see how, he has been going through year over year negative growth, but that's coming back up over the next few quarters. So that's showing you the improvements made both on the cost side of things, helping margins, but at the same time also to monetize some of the opportunities going forward as well. Now, on the other questions about valuations, you raised a good point, and we show that on slide 4. If you look at the S&P, it's not cheap. Right now, it's trading at about 18 to 19 times. But if you look a little bit kind of underneath the surface, what you see is that mostly driven by a few names like megatech kind of names. If you look in the top 10 companies in the S&P, 7 out of 10 are growth tech names. You see on the bottom like Microsoft, Apple, Amazon, Nvidia, Google, Meta, and we also included Tesla. We think it's part of that group of names. So if you look at these names, they're trading at around 30 times. It is elevated. Now, if you look back to 2020, it was trading at 55 times. So, definitely it has been, expanding the multiples for these companies, but it's about 40% below what it was, at the extremes of 2020 and 2021. I think it's going to be important to, on a stock by stock basis, understand which companies actually deserve 30 times earnings among this group and which one don't. And just to tie to the US tech fund, if you take Apple is trading at 30 times earning now, but we kind of struggle to see how over the next 5 years, they're actually going to be able to grow or outgrow expectations from here at 30 times earnings. So that's one of the names which we feel a little bit more cautious at these valuations. And you won't find Apple in our top 10, for example. It's less than 2% kind of a position for us. In the S&P, it's about 7 to 8%. In NASDAQ, it's more than 10%. So this kind of concentration might have some risk attached to it, but it's very much on a company by company basis. Now, if you look at the S&P excluding these 7 companies, and that's the light blue line you see at the bottom, the valuation are around 13 to 14 times. So it doesn't feel like, expensive in this case. And if you look compared to, a couple of years ago, it's well below the level we are seeing. So it's kind of a bifurcated market where some mega tech companies have been expanding valuations. Maybe they're a little bit too expensive for what they offer on a case by case basis. And then there is an entire rest of the market which has been left behind from this rally so far, and it's trading at 13 to 14 times. So it's probably a good time to be an active investor, actually, I would say, because of the picture you see here.
So the tech fund's always been a little futuristic. From what I understand is the US tech fund that we've been running is a fund that looks to get into some of the mega trends that are going to play out over the next couple of years a little earlier. Not at the start of their business cycle, but once the businesses become sizable, they become profitable. And that is when the investment team decides to enter into some of these mega trends, so to speak. We've seen what's happened with Nvidia. The stock's just done phenomenally well, given the fact that it's at the front end of artificial intelligence. So could you take us through some of the new mega trends or some of the mega trends, how they're playing out in the US Technology Fund?
Yeah, sure. So if you can go on slide 14, actually slide 14 is a good example because, to your point, we're always trying to think about, what about the next 5 or 10 years for this fund. And I think if you go back to, 2020, when I was in India for the original roadshow, you will see artificial intelligence was there in the slide. And, we have been talking about for 5+ years about this. But I think what you see now, and kind of it's creating an inflection in the adoption of this technology, is that the entire computing experience is changing from one which was kind of being based on a search and retrieve mode on your mobile to one which becoming generative and interactive. And the concept of AI is not necessarily new, has been around for quite some time. But now I think with ChatGPT, last year, what you see is that that's growing at a pace which we haven't seen before. Just to give you an idea, the number of days it took for ChatGPT to reach 1 million users, it's only 5 days. If you look how long it took for, businesses like Meta, like Facebook or Instagram or Netflix to reach 1 million users, it took anywhere from, say, a few months to a few years for Netflix. So that just gives you the idea of how fast this is happening. And it's happening right now. So again, I think over the next few years, if you think in 2030, some of the companies you see in 2020 in the top 10 there might not be in that top 10. And I was talking about Apple and how we are a little bit concerned in terms of, or we can't find what is going to be the opportunity for them necessarily on AI right now over the next 5 years. And vast majority of their business is still down to handsets. So that's one example there. But I think for AI, the opportunities that you have an entire ecosystem, which is needed to, really power this technology over the next 5-10 years. And we show that on slide 15. The first layer is the computing one. So the semiconductor companies. But also think about, the companies providing the equipment or materials or services around, the production of it. NVIDIA, I think it's kind of the extreme example where they are the leader by far on GPUs and graphic processor units, and accelerated compute, which is GPUs, is critical for AI, especially on the training side of things. So they're going to see growth. We expect them to continue to grow on a quarter by quarter basis over the next 5 to 10 years. That's a company we started, actually, we started a position in 2016 for this fund. The sizing of the position has not always been big, but now it's quite a big position at 4 to 5. But, there are companies which are less understood, which can benefit from these, like Synopsys. It's a good example. It's a company which is a leading provider of EDA, electronic design automation. They provide the software which the companies like NVIDIA are going to use to design the chips. And it doesn't really matter whether it's NVIDIA or another company which is going to benefit the most. They're going to see more and more demand for their services. So that's the first layer. The second layer is the infrastructure one. Data center, the hardware and networking, it needs to change over the next few years. And, clearly hyperscalers like Alphabet, Amazon, and Microsoft as cloud providers, they are on the good side of the change on this. But there are also new, companies like Oracle, which you haven't thought maybe in the last 10 years as a growth companies, can now go back to growth because they're taking some share of the cloud market over time. And also company like Equinix, which is just think about data center being a critical part, but being able to manage data center. This is a real estate company, the largest real estate company, which provides data center colocation services, can benefit over the next few years. And then, the parts which are maybe, 3 to 5 years down the line, in terms of monetizing this is the software side of things and the consumer one. I think software, we're starting to see that with some of the generative AI applied, like the likes of Adobe on Photoshop, their new generative field. That's one example, but also company which can provide services to enterprises, then can also benefit from this. And then finally, just think about on the consumer side, you have companies with huge data sets. These huge data sets, once you can apply AI onto it, can be something quite powerful. So, just think about something like a Uber, which can use software tools, AI software tools on their data sets, or, company like Dexcom on the healthcare side of things. That's potentially, really powerful, but again, might be a little bit more down the line. So if you need to think about, it starts with the computing power, the semiconductor companies, moving on to the data center one, and then finally software and consumer. And that's something which happens over the next 5 or 10 years.
So you spoke about artificial intelligence. I'm sure there are multiple mega trends that are playing out in the US Tech Fund. Would you like to speak about some of the other mega trends that we see, playing along with artificial intelligence that are at this point probably great to monetize and build a portfolio around?
Yeah, sure. I mean, I would say, actually, we already see companies monetizing on AI. So not necessarily like saying that is something, far away from now. NVIDIA is the example where you've seen their guidance went up by a few $1 billion next quarter. So I would say what we see and what we need to appreciate better is that over time, what you see is that technology is becoming more and more involved in every single sector of the economy. So rather than just like talking about one single mega trend, whether it's that cloud or whether it's that EVs, what I would say is really interesting and what makes this strategy interesting is that over time, you see companies which are not classified as technology by, say, geeks, but it might be energy, it might be industrial companies, it might be healthcare and so on, which are becoming more and more like technology companies. They think and they act like technology companies. Just think about this is not a company we own, but it's a good example. John Deere, it's a company, it's a tractor company, but they're now, selling software, which is then used on, their tractor to help farmers to increase yields and to also reduce the waste of things like chemicals, fertilizer, and so on. So that's just one example. I was talking about Dexcom before. It's classified as a healthcare company, but we see them as a data company. What they do is they're the number one, the leading provider of continuous glucose monitoring systems, a small sensor you put under your skin, which measure what's the level of glucose in your blood. It's useful for people with diabetes. Every few minutes, it will send wirelessly data to Dexcom platform, which is able to analyze these and provide a better outcome for the client. So I think the single biggest mega trend, if I would, were to summarize, is the fact that technology is taking over every single sector of the economy, and we see that as a secular trend over time, which has implication for companies in the semiconductor space, but also in the software space, as well as companies which are not necessarily in these two places, but in other areas like renewable energy being one of them. We own a company called First Solar, which has developed, if you look in the top 10 panel producer in the world, 9 out of 10 are Chinese. The only one is First Solar, which developed a different technology to produce solar panels, for example. Company like Dexcom, as I mentioned, we own company like Rockwell Automation in industrial, which again is provided robotics applied on factory 4.0. So there are a lot of things going on, but the biggest trend is this one, which I talk about, how technology proliferates across sectors over time.
Sure. So there's another thing that comes to my mind straight out. You mentioned about how US equities are behaving. You also mentioned about how interest rates are going to change. The rate cycle is going to change next year. Is it a safe assumption to make that in 2022, as tech companies got sold off or tech stocks got sold off, the reason was most investors were basically holding a lot of tech stocks in their portfolio. So when they wanted to book profits, they automatically went to stocks where they had made money and what they held in their portfolio. But now that, we will see in 2024, most likely investors coming back into equity markets if they haven't already started in 2023. Is it safe to assume that they will go back and buy some of these tech companies, and probably not the giant cap tech companies, but the next leg of growth companies, some of which you mentioned in terms of Dexcom or NVIDIA or even a Synopsys? Is that assumption safe to be taken up?
Yeah, I mean, I would say for last year, and maybe you can just quickly go on slide 13. I just want to show you something about software companies. But I think the, the reason why last year we have seen that sell-off is a combination of things. The first one is that we have seen valuation at levels we haven't seen in a few decades for some companies. And here you can see for software as a service companies, we track the average company was trading at around 18 times back EV to sales back in 2020, 2021. Some of these companies were trading at 40 times EV to sales. We haven't seen that since the dot-com bubble. So, as you went through a very aggressive hiking cycle from the Fed, a lot of these names have been, left behind. And then secondly, the expectations for these companies were very, very high. After 2020, there was this expectation that the growth rate would stay elevated, as in during the pandemic, but that didn't really materialize. And we have seen that deceleration and company missing estimates. So this kind of combination and some of that component, as you mentioned, of like maybe clients have been reducing some exposure at the same time, accelerated that like sell-off we have seen last year. Now, if you look at it, like the valuation for these companies on average went well below those two lines, dotted lines you see. The upper one, it's the average for the last 5 years. The one you see, below, it's the average of the last 10 years. So does it really matter whether you look at kind of medium term or like a little bit longer term? The valuation got to a point last year which embedded a recession for these companies. Since then, we have seen a re-rating, but as you can see, this one is showing end of May data. The end of June is kind of similar. They have expanded, but they are nowhere near to what we have seen over the last few years there. So to some extent, like I think, we have seen clients, appreciating the fact that these companies were trading at like cheaper valuations that we haven't seen over the last 5 years or so. And then secondly, we have seen some improvements on the outlook of these companies, which also contribute like to some extent on the upside we have seen on the market. So I think to your point, where you've seen the concentration in the rally has been the mega tech names. When we think about 10 years from now, the opportunity might come from below, might come from maybe some small caps, like some mid cap company. I think that's true. Like, usually the disruption in tech means that like some of the bigger names will become smaller over time. They might not be as relevant. And if you look over the last 10 years, I think only 3 companies out of like 10 are still in the top 10. So in the context of the portfolio, we have been adding smaller names since the beginning of the year, where we found that combination of the valuation got reset last year. And these are also, disruptive company, which are growing very, very fast. I just mentioned a couple of names maybe on this, like we added in the semiconductor space, a company which is called Rambus, which is a small cap technology company, another company called Credo Technology. Rambus makes industry-leading chip, which are specific to data center. And I talk about how in AI, data center need to go through like periods of like where, they're basically going to change in the infrastructure. And, Rambus is set to benefit from that. In particular, they specialize on server DRAM, which has been in a downturn. But again, they are seeing newer application related to AI, and we expect them to outgrow those expectations over the next like 1 to 2 years. Another example is Credo. As I mentioned, Credo also makes chips and components, which helps hyperscalers, especially to solve for kind of the bottlenecks between memory and processing. But at the same time, is a pioneer in active electrical cables, which is a type of cable which is taking market share in data center away from copper cables. They are much easier to use. They take much less space in a data center. Once you start to move more data faster, copper cables become bigger and bigger. But these cables, they solve for that. So that's another example of a kind of a smaller names we have been adding on the semi side of things. And then because of what you see on that slide, also on the softer side of things, we have been adding kind of smaller names in the small cap or mid cap side of things. Names we already owned, but we just add exposure there. So names like, just like one example there, like MongoDB, which is a data infrastructure software company. That's one example, as well as like in the mid cap, like HubSpot, which provides marketing like services for small and medium sized companies. So we have been finding opportunities over the last 6 months in the mid and small cap area of the market as well.
Fantastic. Christian, on that note, I think it's a good time to jump straight into our top holdings because, as I'm speaking to clients and partners, I always get this question around the portfolio where people think the portfolio is loaded up with NASDAQ mega caps. And to a lot of people's surprise, when we jump into the real portfolio, the top 10 holdings, we find that it is quite divergent from the giant caps that people believe that the portfolio will hold. So on your screen, we have the top 10 holdings with their portfolio weights. And Christian, you spoke about NVIDIA, you spoke about Meta, you also spoke about Synopsys, Netflix, and Oracle. You spoke about MongoDB. What does, or how different does this portfolio look from NASDAQ? And, what does this portfolio augment in terms of future returns for clients?
Yeah, sure. So I would say that when you think about NASDAQ, what you get is effectively a very concentrated portfolio around basically 3 names. These 3 names are Apple, Microsoft, and Amazon. And, of course, these names have been great companies over the last 10 years, companies that we owned in this portfolio as well. And they used to be, top 3 names, for us, if you go back in time. But here, I think the difference is if you look over the next 3-5 years, where do we see the best opportunities? Where do we see the best risk reward? And, to us, owning more than 10% in Apple right now is not something that makes sense. If you're really looking at what the company is offering you in terms of growth opportunities. Similarly, if, Microsoft is a great company, and we own it, but we think it's kind of well appreciated what they've done. Of course, they have a lead on AI because they backed OpenAI with ChatGPT. But at the same time, again, it's well appreciated. People understand that. So that's why you don't see, for instance, these companies in our top 10. So again, it's quite different if you have a company which is more than 10% in NASDAQ, and here you don't even see it in your top 10. So that's less than 2.5% of that. However, I would say that doesn't mean we don't own large cap companies. If we see an opportunity, and again, if you look at Meta, it's a 5.5 position. It's a company that, again, last year, they have been doing a lot to improve on the cost side of things, and also to see that kind of reacceleration in revenue growth. But when you think about artificial intelligence, their positioning compared to Apple, it's very, very different. And they own massive data throughout their ecosystem between Facebook, Instagram. These are some of the biggest platform in the world, with like a few billion people every single month, posting onto it, posting pictures and sharing information effectively. And they can use AI, and they've already shown they can use that on, for example, on Instagram Reels to better monetize, advertisement and to target much better advertisement for people. And that means you have much higher ROI if you're in advertising, deciding where to advertise on this platform. And you'll go to Facebook, you'll go to Instagram, and they can, monetize this opportunity over time through AI. So again, it doesn't necessarily mean we don't have those large cap names, but it's where we can find the opportunities in some of these names, and we think they're going to outgrow the expectation over time. And again, everybody's talking about NVIDIA for the right reasons. It's up a lot. But when I look like year to date, Meta is up 140%. So you kind of need to appreciate that there is more opportunities out there. Like it's not necessarily 1 or 2 names But at the same time, you can see, again, companies like Oracle, that's a company which is seen as mature tech company, but has been doing really, really well for us and is reaccelerating that growth through Oracle Cloud database. And they are one of the kind of key layer across any enterprise. So they have the opportunity to monetize this going forward. And then if you go down, you see, as I mentioned, MongoDB, which is a little bit kind of at the earlier stage of their life. But, data infrastructure is going to be critical also for AI application. So we see, these companies like Mongo or Confluent is another one we own in that space. It's going to become a critical piece within software over time. So the opportunity is there. And again, we are creating a more differentiated portfolio, which doesn't look, it might own some of the NASDAQ name, but it doesn't look and feel like NASDAQ once you start to look what are the top exposure you have. And we do so with much less concentration as well over time. So again, if you sum all of these 10 names, you compare to the top names of NASDAQ, you will see a huge difference there in terms of how concentrated that rally, has been in the markets and how concentrated NASDAQ has become also because of that.
Why don't we jump into valuations and look at if clients are overpaying or paying the right price for the portfolio that we have on hand? How do valuations and earnings look in terms of the portfolio of the US tech fund?
Yeah, sure. So, in terms of the valuation here, what you see is this is based on consensus data. And again, we are trying to get exposure to companies where we think they can outgrow those expectations. So in reality, the P we would expect is lower than what you see here because our earnings estimates are higher. But you're looking at about 28 times right now, end of June, for an EPS growth of a little bit higher than 20% over the next 12 months. So it's not cheap. Once again, if you go back to, that slide I show, some of the mega cap names are trading at around 32 times earnings. But if you look at the growth profile it's giving you, so it's a little bit cheaper than the top 7 companies in the S&P, but the growth profile you should expect is higher than these companies and higher than the overall tech sector as well. So you see on the right side, our benchmark is looking at around 14% earnings growth from our perspective. I think it's also good to highlight that that's coming with higher profitability. So once you look at the ROE of the fund, that's higher than what you see in the one of our benchmark as well. So again, it's not cheap for sure, but you're paying for, in a world which is kind of slowing down, if you think about, you're paying for a portfolio which has the potential to deliver, more than 20% earnings growth over the next 12 months.
So essentially, we're paying for growth, which looks good over the next 1 year and ahead. It'll be great to jump into returns now or performance specs, since investors are tracking that closely as well. Now, what you will see here is in terms of the fund in US dollar terms, year to date, the fund is up about 47%. 1 year returns stand at 40%. This is, mind you, back at the on the fact that 2022 wasn't a great year. The fund, if you take a look at the chart below, 2022 calendar year performance, the fund was down about 44%. And the bounce has been quite spectacular. If we go to slide 21, what we will clearly see is the fact that the fund has not just outperformed the benchmark, which is the Russell 1000 equal weighted tech index, but look at the performance against NASDAQ, which a lot of people peg this fund against. Over a 3-year period, it's given you returns similar to NASDAQ, but once the bounce in tech companies started back in the last 1 year, what you see is clearly an outperformance to NASDAQ. And year to date, it's just blown the lights out compared to what NASDAQ has done. So the point that Christian mentioned some time back is the fact that some of these companies are high growth companies. Even if you're paying a bit of a higher premium for that growth is well rewarded. So with that, I think let's go into the Q&A now, since we've been on this for over 15 minutes. Participants, if you've got any questions, I would request you to put them up in the chat window. We will take those questions and answer those questions. Christian, I have a couple of questions that have come straight before we made that announcement. One of them is the fact that the framework or companies like Intel, etc., which are old technology companies, do they figure out in the portfolio that we have on hand?
Yeah, sure. So basically the question is whether we own any of the kind of more like older. I would say that exposure is very little for us. I think among the bigger position, Oracle is probably the closest I can think of a company like that, at least over the last 10 years, have seen as a mature company. But one which is changing and is finding new way to grow. So I think it's a little bit different there. Other than that, I can think of like, again, perhaps like in the software space, when I look through it, the names that we own, something like a Salesforce. But I would say, Salesforce is much more growthier compared to something like an Intel out there. So the focus of the fund is more about like companies which have a disruptive business model and a growth opportunity ahead, rather than going into necessarily or mature growth or like mature value kind of names, perhaps in the case of like the likes of Intel also. So usually we will like companies which have a large market, but that market is changing over time and they can monetize on that opportunity as well. And that's why we had that position in NVIDIA, for example, for quite a few years already. We had a position in AMD, which has been taking market share away from other players in the CPU market. And we see that continuing in the future. So that's where we usually tend to focus the most.
A question straight, which was expected on NVIDIA. Don't you think NVIDIA is very, very expensive given the recent rally in the stock? And also the fact that it's a top weight in the portfolio. Should the fund manager or the portfolio manager look at actively taking that down? Your thoughts on that, Christian?
Yeah, sure. So I would say NVIDIA, it's, interestingly, if you look at NVIDIA valuation before and after their earnings report, the valuation went down. Why? Because, despite the stock was up a lot, their earnings, over the next 12 months went up substantially going forward. So I think it's all, one can see it as an expensive name. For sure, it's not cheap. But it also depends on what's the expectation that one has from an earnings perspective from the company. And again, we have in front of us years of basically converting the current infrastructure, as we know, which is based on x86 and CPUs on GPUs, accelerated compute. And they have been almost the entire market share of that over time. So that's why, we still feel quite comfortable in owning the name and own it relatively big right now. We have been trimming, but because the stock has been doing so well, the position is still relatively large. But we are quite comfortable of the fact that they're going to monetize these over a multi-year period, as you need to go through that kind of, infrastructure spend because of AI over the next few years. So you have seen, that pattern of like the earnings, like their earnings expectation to go higher, and we will expect that to continue basically into the future to see once again, guidance, which probably is going to be higher going forward as well.
In fact, to no surprise, I have a couple of more questions on NVIDIA, but I think you've answered it.
Maybe the other thing which I didn't mention is that people think about NVIDIA as purely as a semiconductor company, but the reality is they are also a software company.
Yeah,
as they have been developed their software, which is being used quite extensively by a huge community of like developers as well. So if NVIDIA will be just a pure semiconductor company, maybe we will be more worried about that, but it's really the combination they have of being semiconductor as well as the software component, which over time makes it really, really a strong company.
Brilliant. The next question is around growth versus value. We saw 2022 play out where value stocks did exceptionally well. Some of them have basically paused and growth stocks have started going back up. The question is, do you think this trend will continue over the next 2 to 3 years? And I will club another question with that, which is if an investor has to choose between S&P 500 and the US Technology Fund, should the investor be choosing the US Tech Fund over the S&P 500, or there should be an equal mix? So your thoughts on both of those?
Yeah, sure. So on the first one for growth and value, I think in the primary determinant of value, doing better is usually sectors like financials, sectors like energy. So the more cyclical parts of the economy. And on slide 7, I show, for example, how energy went through like very strong growth over the last few quarters year over year, but that is been coming off. And, we would expect that to become eventually like negative growth for the sector for a few quarters. I mean, financial has been going through some of that, but I think if we do see some risk to the downside, for example, on the economy, banks are the first one to probably be, hit by that. And at the same time, you also have, what we are seeing with regional banks and, potentially new regulation coming on banks, which might constrain their ability to, get their returns effectively, as they need to keep on more capital. So I think because of this, although maybe one can make like evaluation, kind of a relative valuation case for value. At the same time, from an earnings perspective, it might be going through a little bit more difficult time compared to parts of the growth market which are already coming out of that earnings recession. So that's why maybe is one to keep an eye on. But again, if you just look at the fundamental, the earnings, it doesn't look spectacular right now for parts of the value market. In terms of the question on the S&P and US Tech, I mean, I would say that the S&P will give you a little bit more diversified exposure across parts of the economy. So, perhaps like, US Tech can go alongside some S&P or even some value exposure. Just thinking like how US Tech provide you your like growth exposure, across mostly tech, but also some a little bit outside of tech. And maybe you want something a little bit cheaper, and you go directly into value rather than owning the S&P. So you kind of blend value with like tech at the same time. So it's either one or the other, the way I would think about it.
I would actually think about it a little more differently. For investors who are Indian investors, you've got a lot of banks in India. Our index is overweight financials and banks, and you've got banks with a huge runway of growth, which probably American banks don't present in terms of, the fact that a lot of Indians are still not covered with adequate banking. If you look at consumption, if you really want to go into a big consumption story, India's turning out to be a big consumption story. But if you really want to diversify your portfolio, you want to go into themes that are new age, themes that are quite disruptive and innovative, I think the place to go is the US Technology Fund. So what that also does is gives investors a clear diversification in their portfolio. So, as an investor, you'd probably want to have an overweight position on the US Tech Fund compared to an S&P 500. Christian, couple of last questions that have come through, which is, how does the portfolio look between new age and traditional tech companies? And what's the mix between small, mid, and large cap in terms of the portfolio that we hold?
Yeah, sure. So for the first question, kind of like new age versus like more mature company, I will say that we draw a specific line there. It's more about what's the growth opportunity we can see in some of these names. And if we see some mature tech companies which are changing and they're seeing new growth opportunity, one could argue that Microsoft a few years back, before Microsoft Cloud, it was one of these companies. Then we are very happy to own them. And we've done really well with Microsoft over the last few years by owning them. I mean, Oracle is the other example there, which is a little bit more recent. Salesforce is a little bit another example, which is a company which spent a lot on acquisitions in the past to grow. Now they are much more focused on growing in a profitable way, reducing cost and improving margin as well. So we are happy to own some of these companies. But at the same time, I would say a large percentage and the majority of the fund is in companies which are a little bit more growthier in nature than these ones. So that's where you see we own companies like Nvidia, Tesla, Netflix, AMD, Mongo, and so on in the top 10, for instance. So there is no clear line, but it's more about what's the opportunity from a growth perspective going forward. It's very difficult for a tech company to reinvent themselves, but some of them, they're being successful in doing that. In terms of the market cap, I'm not sure if you have it here. Maybe, yeah, we have actually on slide 19. On the bottom left, you can see the split. And this one is not kind of necessarily telling the whole story because, we define large cap as more than 50 billion. But, there is quite a big difference between a 60 billion company and a 1 trillion company. So to some extent, here what you see is just part of it, but let's just say roughly between 65 to 70% is large cap. And then the remaining, 30-35% is in small and mid cap companies. We have been increasing a little bit that small cap exposure of like less than 10 billion. It was much less last year, as this company were facing problems, in terms of like declining growth rates, like higher interest rates and some unprofitable names. But we have been increasing that exposure there. So about let's say 35% is small and mid cap right now. And again, in the more than 50 billion, what I will point to is, again, we have less exposure to the likes of Apple, Microsoft, even Alphabet of the world right now compared to what you will think a traditional tech index will own of them.
Sure. Final question, Christian, which is the funds given out stellar returns over the last 1 year. We've seen year-to-date returns stand upwards of 50%. For an investor who would wish to come and participate in the tech stock universe and wants to invest in the fund, how would you figure it out as a good investment strategy? Should people stagger it over the next 12 months, or people should come straight in and invest one shot, given the fact that we might have a couple of rate hikes on the horizon, and we might also have some bit of volatility coming through. So how would you think a good investment strategy in terms of systematically, or just go one shot in?
Yeah, I would say, adding a little by little is always kind of the more safer choice. And because if you are going in all at once, you're effectively what you're doing, you are market timing. And, that can go well or can go wrong. And I think, just as an example, in, let's say, November or December of last year, if I would say, this is the time to look at it, I don't know how many, investors would have been comfortable after seeing the NAV declining to go back in, like all at once. So I think similar way one can think all the other way around. I think, going systematically, little by little, like every single month, usually tends to, provide a better outcome over the longer term. And again, the fund is up 40-something% year to date. But the reality is that we are not back yet to, where we were at the peak like in 2020 to 2021. So, that means there is still more room to grow. And I think over the next 3 to 5 years, as all of the trends we've been talking about technology comes through, we will be surprised probably in terms of the next leg of growth going forward. Like we have been surprised in a similar way about ChatGPT and what they've been doing and what that meant for a company like Nvidia going from 5 to 9 billion revenue from one quarter to the other one. So that's the essence of tech, I would say. Disruption is constant, and that creates opportunity over time.
Brilliant. Thank you so much, Christian, for your thoughts and all the insights that you've thrown today. Thanks a lot. If the participants have more questions, I would request you to please reach out to your respective relationship managers and put them forth. We will get them answered for you. But I also take this opportunity to thank all of you who have participated on this call and heard our views on the US Tech Fund. And I wish you all well and have a pleasant evening ahead, and look forward to seeing some of your investments come through. So take care and bye-bye. And thank you, Christian.
Thank you. Thanks for the support. Bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.